The broadcast is now starting. All attendees are in listen-only mode.
Hello, it's David Piccolo. I'd like to welcome everybody to the August in 2019 version of TaxChambers webinar series. Today I'm going to be devoting the hour towards discussing the tax treatment of real estate transactions, and we're going to discuss a few topics there. Before we go into the presentation, I just want to go over the ground rules again. So you can ask questions through the GoToWebinar program here. You should see a space where you could send a chat to us. In addition, you should be able to see a spot where you can download the slides as a handout. There should be something there. If you don't see it, don't worry. We will send the slides by email to everybody when we send out just a thank you email to all the attendees. So you will get a copy of the slides after if you're not able to download them now. So don't worry about emailing us a copy of or an email saying, can you please have a copy of the slides? So look out for that email to come out either today or tomorrow. And that email will also act as your certificate of attendance. In terms of just one last thing, we are recording this webinar, so you will be able to review this if you'd like. There will be a link in that email as well, basically letting you rewatch this webinar on YouTube. So once again, feel free to ask your questions through the chat function, and I will answer them probably on the on an as requested basis. There will be a time at the end for final questions as well, but feel free to ask the questions as we go along. Because I'm the only speaker, there won't be any sort of problem me stopping and starting as we go from there. So I just want to present the outline of what we're going to talk about today. So I think a lot of the both income tax and GST consequences that we see in real estate transactions is primarily a function of the entity. Obviously, there are transactional issues, but that's the first issue we wanted to talk about. And then as part of that, we're going to review issues such as the principal residence exemption, income versus capital discussion, some planning considerations when you transfer real estate between entities, and then some common GST, HST traps with respect to builders and the self-supply rules. So those are the main topics that we're going to discuss in today's webinar. So the first and I think the most fundamental issue with respect to any real estate transaction is the choice of the entity who is actually going to be the owner of the property. And really the choices that we have are to be held in individual name or co-ownership. So you have a partnership, which is different from a co-ownership, where you have either a limited partnership, general partnership. You have a corporation, trust, or a joint venture. So before we continue any further, I'm just going to have, I'm going to launch a poll, and I just want to see what you guys are seeing in terms of what's your most common entity that you see your clients holding real estate. It is sort of a mixed bag, and I know that you'll have different clients that are going to hold properties in different ways because they're going to be different in different situations themselves. And again, whether you're dealing with a builder, you're dealing with an individual, you're dealing with maybe an incorporated individual, there's definitely going to paint how they're going to do their planning with respect to the entity. So I'm just going to give the poll another 20 seconds or so, just so that we get a good sampling of results from everybody. All right, so I'm going to close the poll. We had about 75% of the people voted, and the two that were the clear winners were corporation was about 50% of you, and about 42% were individually, and there are about 6% that have a joint venture, and 3% as partnership. So it's an interesting mix, but I'm not surprised that corporation and individual are the two most commonly held. So let's talk a little bit about when an individual is the owner of the real property. So ultimately, the income and potential capital gains are going to be captured by the individual or the co-owner. And again, I'm just going to use the individual in the singular version in the slides, but it does apply on a pro rata basis if you do have co-ownership. And obviously the biggest tax issue that we see when we have a personal owner, at least on the income tax side, is whether they qualify for the principal residence exemption. And just as a reminder, so the exemption only applies to capital gains, not to business income. So you will see in situations where the taxpayer is being audited that when CRA converts their gain to business income, they lose in two ways. Both, not only do they go from zero inclusion to 50% as being a capital gain, but they then go from 50% to 100 from the capital gain to the business income. Now, the exemption applies to a property that is a housing unit, so it doesn't have to be real property per se. So there could be situations where you do have a van or a trailer or any sort of temporary structure that may be considered to be a housing unit. And further, it applies to the whole of the housing unit. So where you have a situation where the taxpayer is renting, let's say, the basement, CRA's admin position is that the whole of the housing unit hasn't been changed. And in these three criteria is in the current income tax folio on principal residence at paragraph 259. This is also their from their old IT bulletin. And essentially, as long as the income earning purpose is ancillary to the main use of the property as a residence, there's no structural change and there's no CCA claimed, then we're fine to claim the principal residence exemption on that portion of the property. Now, there was an interesting ruling that came out in 2015, which did say that CRA would be fine if CCA was claimed when the parent leased the property to the child, to an adult child, and that it would not disqualify the parent from claiming the exemption. I think that's a unique situation, as we'll see on the next slide when we deal with the other qualifications to get the exemption. But that is sort of just an interesting sidebar. The other thing to think about is when you have, let's say you have a duplex or a triplex, and you have, in one unit, you have the husband living in there or the parents living in there, and in the other unit, you have the kids living there. So the housing unit in that situation would be each unit in the duplex or the triplex, as opposed to one larger unit. Now, this may be helpful where you have an adult child and you want to multiply the residence exemption, but just keep a note that the housing units can be made distinct in that way. Now, we do have a question. The question is, does the basement rental still count as ancillary use? The basement unit is a legal suite, and the owner has never ordinarily resided in that legal suite. So I'm assuming that either this is a unit used for a business use. So this is whether it's leased out. It would be odd for it to be leased out to a second person. But the question becomes whether the income earning purpose is ancillary to the main use of the property. So if we're talking about a third of the house here, this is the single unit below. Again, if this is approximately a third of the house, it's not the majority of the square footage of the property. And additionally, that this isn't a property that was purchased originally as a commercial unit, which again would be odd for that to happen. But assuming that that's the case, then presumably that would be ancillary to the main use of the property as a residence. I would say that this is by and large a question of square footage as opposed to anything else. So if you have sort of the main bulk of the house being used for the residence, then I do think that you fit within the admin criteria of or that's listed in the tax folio. It does become a little bit tricky when you start getting towards the borderline, once you start in the 40% of it, because then CRA may start to consider, and we'll see in the GST context where this comes into play, of what you're counting as part of your square footage. And I would say that you should be including as part of your square footage things like the garage and things like terraces, etc., that you would be using as part of the house. But yeah, that would be my thoughts on that particular fact pattern. Now, the principal residence exemption. Oh, sorry. Just to go back or to deal with this. So this exemption is only available when the owner, meaning the beneficial owner of the property, is an individual. So if the individual is on legal title, he or she owns this property on behalf of someone else, and there's a trust situation, then the legal title holder is not the one that should be claiming the ownership or the exemption. It should be the beneficial owner. Now, one that has tripped up people before in audits is that the principal residence exemption must be designated. Now, I know CRA has indicated in, I think it was last year's budget, and has clarified that this must be the filed going forward. But this has always been the case. The Income Tax Act has always required the designation on the T2091. Now, for a previous year, if it hasn't happened, a late file designation may be accepted by the minister and the legal authorities under sections 223.2 and 3.21. That's a discretionary. It's a discretionary acceptance by CRA, but certainly it is one that they are able to potentially late file. But without the designation, technically the taxpayer has not claimed his exemption for that particular tax year or tax years. Now, the property must be ordinarily inhabited in the year. So this leads to the possibility of multiple properties theoretically being potentially designated as your principal residence. And there is no bright line test to determine whether a property is ordinarily inhabited. So you have a situation where you have your main house and your cottage, and if you can show that you go to your cottage every weekend from let's say May to September, and you do that over a course of the years, you ordinarily inhabit the cottage. Now, whether as a practical matter it makes more sense for you to designate your house or your cottage as your principal residence is really a numerical question. You obviously want to use the exemption to shield the most gain possible, but theoretically either one is available. And finally, the question of who ordinarily inhabits the property, it only applies to the taxpayer, their spouse, or common law partner, or by a child of the taxpayer. And that child could be an adult child. And that's CRA's position in that, for reference, is 2014. And I won't read out the rest of those numbers. Further, even if that adult child is charged rent and it's market rent for that property, they still meet the test. Now, this runs into this question before previously about whether you have had a change of use there. And that's where I think, as a practical matter, I would say that if you're renting, for example, the full unit as a rental to your kid, have you really had a change in use? And there, I think we run into a real borderline question, because presumably, if you're charging the kid market rent, then I would say you probably have a change of use there, because you're charging the market rent. It's not necessarily an income, or sorry, an expense sharing arrangement. So if you were charging them, $200 a month, they were basically covering the expenses, etc. I would say that that's more of an expense sharing arrangement. You don't really have a source of income there, or a source of property income. You're just basically doing the family member a favor. But that was what you see in a CRA policy. Now, I do see some questions, so I'm going to answer them now. So the question was, can each brother claim the full principal residence exemption? So just remember that the exemption applies, it is shared by the family unit. So that's number one. So if you have two adult brothers, they're not considered to be a family unit for the purpose of this test. And then we run into a situation where if we have a co-ownership situation, so if each brother owns 50% of that property that they reside in, then each of their halves they can designate as their own unit. Now, if the brothers each reside in the property and it's owned by their parents, then their parents can also claim the residence exemption, because their children ordinarily reside, and that would meet the test. Now, if it's owned by another relative, then it may not qualify, because the taxpayer is the owner of the property. If it's an uncle, for example, the uncle wouldn't meet the test of it ordinarily being inhabited by themselves, their spouse, or by their children. So really, that's how we have to look at the exemption. So to answer that question there, it really depends on who is the actual owner of the property. Now I'm going to look at, sorry, I missed a part of the question. Two pieces of property. So the question is, if two brothers own two pieces of property side by side, and each brother own half of each of the property, and one brother lives in one and one lives next door, then yes. So I think in that particular case, each of them is entitled to their own property, as they're considered their own family unit for the purposes of Section 54. All right. So another question: what about a grandson renting their property? Would this qualify? So that is a good question. So I'm going to see if I could. So there is the extended meaning of child. And that's in Section 251. So I'm just going to quickly go there. Sorry, 250 or 252. It's in one of these related sections. Apologies. If you just give me 1 second. I don't believe that the extended meaning of the child, yes. So the extended meaning of child does not extend down to a grandchild per Section 252 sub 1. So unfortunately, in that particular situation, if the grandchild is the one who's the tenant, then the fact that the grandkid is the one living in the property would not make the grandparent eligible for the exemption. And finally, the principal is only, so the question here, the principal residence exemption is claimed by the parents and the children based on their percentage of ownership. So again, it's claimed by the taxpayer, so it's a question of the owner, but to the extent that you have multiple family units dealing with each potential, if they're co-owners of it, you may have each of them claiming their own portion of the property or have the exemption with respect to their portion of their capital gain. Now, another common fact pattern that we see is a change of use. So I already mentioned it. So the result of the change in use in 45 sub 1 is that there's a deemed disposition. Now, there are two common elections that could be filed to prevent the result of the 45 sub 1 deemed disposition. Now, the 45-2 election applies when the use is changed from whatever it was before. So it doesn't have to be necessarily a principal residence. It could just be a vacant property for all we know. As long as the change in use is to an income earning purpose, the election under 45-2 is available. Now, the effect of the election is that when the election is filed, the change of use is deemed not to happen until the first day of the following year in which the election is rescinded. And essentially, the election is filed with the taxpayer's tax return. Now, it's a little bit tricky because there's no prescribed form, but a letter simply saying that the taxpayer is electing for 45, is electing under 45-2 to apply to the property at 123 John Street. That suffices as making an election under that particular section. And as long as that's filed with the tax return, you have met the criteria of 45 sub 2. And in addition, there is the way it does work under the election and how it works with Section 54 is the taxpayer potentially gets an extension of 4 years to claim the principal residence exemption for those years. So those are years that theoretically they are earning rental income. They get up to 4 years potentially of the principal residence exemption being available for that particular property. And that's pursuant to 54, the definition of principal residence exemption, sub D, which refers to sub B. And then sub B applies with respect to these elections that we're talking about right now. Now, there's a second election in 45 sub 3, which says that where a taxpayer changes use from income producing to a principal residence, so the flip side of 45-2, or at least one of the potential flip sides, it also prevents the application 45 sub 1. Again, there's no prescribed form. And so again, a similar letter basically saying I elect for this provision to apply with respect to this property is more than sufficient to claim or to file this election. And again, it's to be filed with, and again, this one here has a little bit of a different time frame. It's either filed with the tax return in the year in which the principal residence is finally disposed, or 90 days after CRA sends a demand for an election. And essentially what it prevents is from 45-1 to have applied, basically to step up your cost base at that point. So I have a little question just so you can see the mechanics and how the principal residence exemption works vis-a-vis section 45 sub 2. So we have this fact pattern here. So the taxpayer purchases a property in 1999 and they move into that property that year. Now, they designate their previous property as their principal residence exemption for that particular year. They live in this principal residence from 99 all the way to 2014. The taxpayer then moves out of the property in 2014 and begins to rent it. The taxpayer files their 45-2 election in their 2014 tax return. The taxpayer sells their property in 2020, and the taxpayer owns no other properties during this time. So if we think about the residence exemption, it does apply as a fraction, the fraction being the numerator is 1 plus the number of years it's designated as principal residence exemption, and the denominator is the number of years the property is owned. Let's go through I just want to go through the math again just so that you can see. So if you, based on the way 45.2 applies, how many years do we think that this property qualifies for the exemption? So we know it's owned for 21 years, so that's why 21 is the denominator. But let's see if we can count the number of years that the exemption qualifies. And again, this is sort of, I know this might be a very mechanical question, but this is how we sort of have to count it out. At least this is how I think about it. It's really, it seems like a low-tech mechanical way of doing it, but this is how I sort of think about it. So I'm just going to give you guys another 15-20 seconds. So the webinar will go a little bit silent as you're answering the question. All right, so I'm going to close the polls now, but the results are about 38%, 40% now for 20 out of 21, 23% for 16. So 40% of you got it. So the way that I counted it is 1 plus the number of years designated, which would be 2000 to 2014. So that's 15 years between 2000 and 2014. Plus 4 years that you get for the 45.2 election, so up to 4 years, and then 1, which is just your fixed number in there. So 1 plus 15 plus 4 is 20. So the correct answer that I have is D in that situation. And I do see some more questions. I'm going to sort of plug along just so that we don't run out of too much time. But I do see a couple of questions that I will answer towards the end. So don't worry, I've noticed them, but I will keep going just so that we make sure we cover as much material as possible. So the next choice of entity is partnership. And again, we know that partnership is not necessarily a taxable entity per se under the Act, that really the income is allocated to the partners. The way partnerships are often used for real estate is not necessarily for tax purposes. There are some tax benefits where you theoretically have the potential of losses being allocated out to the partners initially, potentially in a development stage, and then income thereafter. And that is a common reason to structure investments in development, particularly where you're getting multiple investors. I do think that there are other non-tax. It does make the governance and the investment into the project a little bit easier. So that's another common reason why you use limited partnership. Now, in terms of the limited partnership versus a general partnership, obviously a limited partnership has limited liability for all the limited partners. So there is some legal benefits there. That being said, to the extent that you have limited partners and you have situations where you do have losses, you do have to keep in mind the at-risk rules, and that a limited partner cannot deduct or cannot claim losses from a limited partnership beyond their at-risk amount. So that's just something to keep in mind to the extent that that is a relevant consideration for clients. Moving on to corporations. So if a corporation is used as the choice of entity, if the property is being used for personal purposes, do keep an eye out for 15 sub 1. It's really, to the extent that a corporation is used to hold personal property, it's not necessarily the best use or the best way to hold that property. You don't get the principal residence exemption either. It's a very awkward way to claim or to hold a personal property. Now, for those who have taxpayers who are interested in flip transactions, a corporation may be preferential because in the definition of active business carried on by a corporation under Section 125 sub 7, it does specifically include an adventure or concern in the nature of trade. So to the extent that you do have an adventure concern in the nature of trade for, let's say, maybe a one-off transaction, or if you do have a business, and again, active business for the purposes of that section does deem basically it to be any business in Canada that's not a personal services business or specified investment business. So as long as you're not falling into those two criteria, you will be deemed to be having an active business. Whether or not the business is actually active or not, there was a case about this where the business was still was basically inactive, but because it didn't fall into the specified investment income or a personal services business, they were deemed for it to be active. Now, again, if you do have profit or you have a sort of a gain, I called it, that was treated as a capital gain, this obviously doesn't fall into the SBD and would be part of the corporation's aggregate investment income. So it may not be preferential there when you have to flush out the RDTOH, etc. So let's talk a little bit about this income versus capital. It's obviously, we've probably all dealt with these types of situations with clients, just dealing with it in the GTA, or if you're out west, this has obviously been a project of CRA for many years now. And Happy Valley Farms does have the 6 criteria. It's not exhaustive, but these are the ones that are often the most commonly thought about. So it's the nature of the property, length of period of ownership, a number of other transactions, work expended in connection with the property, circumstances surrounding the sale, motive. Now, a house or a condominium is not indicative of either way. The tax court has said that in the Sanga case. So in and of itself, there's nothing conclusive when you're dealing with real property. Length of period of ownership does factor in. I do think that with respect to pre-construction properties, we have to be mindful of when the period starts for the perspective of this portion of the analysis. So ownership doesn't happen until closing finally happens. So to the extent that there's occupancy, that doesn't really factor into the length of period of ownership test here. And what's long and what's short is really a question of fact. It is in the circumstances. I would think that if you're talking about less than a year, CRA is going to consider it to be a short period of time. Whether or not they're right is not necessarily determinative in this particular case. The number of transactions, so more times you're doing this type of transaction, the more likely it's going to be on income account. And also you have to remember that an isolated transaction, so a one-off transaction, may still be an adventure concern in the nature of trade. So again, this factor, again, is not necessarily determinative. And none of them really are. Motive is probably the most important one, and we'll get to that. But none are the silver bullet. So with respect to the work expended in connection with the property, so the more work that's done to add, let's say, if you're improving the property for your own specifications, then it's more likely to be capital. If you're basically, adding value that, you're not going to use it, someone else is going to use it, then it's more likely to be considered on account of income. It really just, again, it's more of a subjective test in terms of what were the circumstances surrounding both the purchase and the use while the property was owned. Circumstances surrounding the sale. So what caused the sale? Was it because you received an unsolicited offer? Or was it because you bought it to tear it down and then to flip it? Or did you intend to use it and, something prompted you from being not able to keep the property and that's why you had to sell? So this is the sort of a thing they're looking at. Again, to the extent that money is the factor, the ability to profit is the factor, that will likely push it towards income. But to the extent that you sold it because either for example, there was some unforeseen change, that will likely factor into it being capital. I would say here that in the circumstances where you've held it for a longer period of time, that this particular factor is not going to hold much weight, because if you hold a property for 5 years, you're more likely to have, that factor is more likely to weigh more heavily than this sort of factor. Finally, we get to motive. And I think this is one where we have to think about a couple of things. So firstly, this is an examination of the taxpayer's motive at the time the agreement is entered into. So we have to put we have to put ourselves in the mind of the taxpayer at the time they entered into the agreement, which is a very difficult thing to do. There's really an evidentiary issue because the taxpayer is self-interested, and we're going to have to infer their intention unless it's documented somewhere, which again would be some self-serving document. But we have to sort of infer it from their behavior. And the case law, I have a couple of slides. I'm not going to read all of these criteria. This slide and the following one is from one tax court case. But I think things to consider is that direct evidence of a person who has an interest in the outcome of the appeal is not determinative. Generally speaking, you want to get additional evidence about why you purchased a particular property. So often these come through, and we've heard them before, changes in life, we get married, we get kids, I'm living in one property, it's not adequate, I need a bigger place. Or vice versa, my kids moved out, I'm going to downsize, so I'm going to buy a condo. Those are certain factors. Now, where you see a quick sale, CRA would say, oh, you probably just did that because you knew the market was going to go up. Well, if we can show sort of the secondary factor, we wanted to move into a condo, but I was not able, 3 years passed and, family circumstances changed, it becomes an evidentiary issue. And I know that there's frustration when dealing with these files, because oftentimes taxpayers don't keep good records when it comes to personal circumstances. So changes in family situation, those can be documented somewhat. Medical issues can be documented somewhat. Perhaps changes in finance also come up, where, for example, taxpayer was working, bought a larger place, then 2 years passes, their property is going to close, and now their job has been lost, or they're in a situation where they're earning less income than before, and they need to downsize again. Those theoretically should be able to be documented, but really it's just a question of the intention. Did you follow through? How closely connected is the evidence that you have that you wanted to seek your intention and actually make it happen? And how close is that event to what actually happened with the circumstances? And that's often the key thing. So when you have, this frustrating event, how does it actually connect is what the thought process has to be. And don't be frustrated with CRA not accepting it at first instance. I know we all have dealt with us, dealing with the first level auditor and them sort of ignoring a whole whack of evidence. Continue with that process, object, appeal, what have you. As long as you have good evidence to show that you can connect the event to the intention, you should feel, confident in the reasonableness of your case. Again, whether CRA accepts it or not is sort of outside of our control, but I think as we're, representatives of our clients, just continue and just keep that in mind. The final thing that you may see is this concept of secondary intention. It's been diminished for about 20, 30 years. I have still seen it in audits and in audit reports where you have the idea is this. So you primarily buy a house because you want to live in it, but secondarily, if you think that it's going to be a good investment and that you keep that in the back of your mind, that's what they think about as secondary intention. It's a very difficult concept because it's very hard to parse out these other characteristics or these other thoughts in your mind. And really, it becomes a very difficult evidentiary thing because it's one thing for CRA to sort of, with hindsight, say, you know what, you knew the real estate market was going to go up, but we don't really know that. I mean, the market has been good in Toronto particularly. But there are corrections, and we don't know that. We only know it looking back that the market improved. So that's why I think the course, in a very practical way, have de-emphasized it. So to the extent that CRA is, holding on to secondary intention, I would contest that particular point. Again, there may be other factors that may not favor the result your client wants. But if this is one that they're holding on, I say contest this one strictly. And finally, I want to go through the venture concern and nature of trade. It is a slightly different test, but you'll see it's very similar. And this is a test that came from the Supreme Court in Friesen, which, I look at 95, that's almost, I guess it's 25 years ago. So it is well-established law. And it's essentially the requirements are as listed here. So you'll see they're very similar. Again, I don't want to necessarily spend the time to read them, but these are the factors that are looked at, and Friesen is the case if you want to go towards it. Now, choice of entity when you're dealing with a trust. So just a couple of things to think about with respect to trust, because trust, there is a whole spectrum of types of trusts and the lot. So I don't want to necessarily go through each one of those. That would be its own webinar in of itself. Just keep in mind that even with the changes to the principal residence exemption, personal trusts may still be able to qualify as long as they're a personal trust, and personal trust is defined in section 248 sub 1, and basically means a graduated rate estate or a trust in which the beneficial interest was acquired without consideration being payable. And if the personal trust is the one claiming it, the housing unit has to be ordinarily inhabited by a specified beneficiary. And that's defined within that section, and I have to give you the reference of C.1 as who would be a specified beneficiary. So it's still available. It's definitely more restricted than it was pre-2000. I think 2017 is the first tax year that it applied. So everything pre-2016 is under the old rules, and under 2017 is under this new, more restrictive rule. The second thing to think about is bare trusts are often used as well. So I've seen it most frequently where individual wants to buy, so the taxpayer, wants to buy the pre-construction property through its corporation, but finds that the builder will not accept the corporation's name. So they often will create a bare trust agreement where the bare trust is held such that the corporation is the beneficiary, and the individual who holds the legal title is the trustee in this relationship. Just keep in mind that a bare trust is essentially an agent an agent relationship. And while it's not defined in the Act, the reason why bare trust exists for tax is in Section 104 sub 1, and particularly and I carved out the second half of that provision, which starts with a trust is deemed not to include an arrangement, and keep reading that. And essentially a bare trust, for you to actually have a bare trust, the trustee has no power, no discretion, no responsibility with respect to the property. It's the beneficial owner is the one that reports the income. It's the one that calls the shots. The trustee is the person that's essentially the puppet that does what the beneficiary wants to do, and that is akin to an agent relationship where the principal controls what the agent does. But you will see that commonly used, or one common use of a trust in a real estate situation. Finally, joint venture. So a joint venture is not defined. Again, it's not an entity in the Income Tax Act. It's more of a term of art, and it generally refers to two or more parties collaborating for a fixed term to deal with a specific type of project. And so that leaves a lot of flexibility to the actual participants of the joint venture to determine the exact terms in terms of how money is going in, how money comes out, how profit and loss are allocated. And it really gives the joint ventures flexibility as to who the parties are. It could be any combination of corporations, partnerships, individuals, co-owners. It's sort of up to the parties to determine how they set up the joint venture. Now, I just wanted to recognize this isn't really an income tax issue, because essentially the income tax side will follow the form of the joint venture. So if you have it more, if it's going to be allocated in a way similar to a partnership, for example, then you will follow the partnership rules. If your joint venture is more of a co-ownership type structure and you have your income allocation per your joint venture, it will follow that. So from an income tax perspective, you basically follow the form. But for GST, HST purposes, Section 273 allows a little bit of simplification. So to the extent that the Section 273 election is available, one of the joint venturers can basically be elected as the operator, and I put the operator in quotes because that's the defined term in the Excise Tax Act. And this election is available for a number of joint ventures, but one of them that's relevant for this project is for the construction of real property or the ownership of real property. And essentially, it just simplifies things by allowing the operator to be responsible for all of the GST. So it's the one that's going to collect the GST, and it's the one that's going to claim the ITCs and do all the remittance. Now, the parties for you to elect in must complete GST Form 21. But interestingly enough, this form is just kept within the joint venture. It's not actually filed to CRA. So it's executed but not filed. And just as a side note, the operator must have some managerial or operational control over the joint venture. It just can't be a simple nominee corporation. So CRA doesn't want you to set up a joint venture, create a shell company that has no skin in the game and it's not going to have any assets, and make it responsible for all the GST, so that CRA is sort of left holding the bag. So that's per their policy. There is some logic towards the policy. Now, when you have transfers between the entities, you have to keep in mind that you have sort of two considerations. So we're talking income tax, we're talking GST. So obviously, the income tax perspective, there are various rollovers moving between into a corporation. There are certain rollovers when you roll into a particular type of trust. So those are the alter ego trust or the joint spousal trust. So obviously, if you don't meet those criteria, if you're not in a rollover situation, or if you're not meeting the definition of disposition 248 sub 1, or that excludes you out of a disposition, then you obviously will have some tax consequences as a result of the transfer. And from the GST perspective, it's really just a function of the type of property. So if you have an individual that's using the property for personal use and is transferring it to, let's say they have their condo, they lived in it for 5 years, they're going to roll it because they're going to do the some rental. That's an exempt supply. So whether it's a taxable supply or exempt supply really isn't a function of necessarily who's using it, or sorry, of who the entity is, but how the entity is being used. But there are some land transfer tax considerations to think about. And in Ontario, this is, and especially in Toronto, where you have both levels of land transfer tax, there are some things to consider. So the transfer tax is calculated on the amount of consideration that's being received. So if you have a gift, person X transfers to person Y, and they do it by way of gift, there is no land transfer tax available that's payable at that particular time. So if you have a rollover of that property, your consideration back is the shares. The fair market value of those shares is the amount of consideration for land transfer tax purposes. But if you have a principal residence and you want to, and it's free and clear of a mortgage, you may be better off just gifting it to your corporation, incur the disposition. Your capital gain is going to be cleared by the principal residence exemption, but you'll save on the land transfer tax. Now, this is only really available if you don't have a mortgage on the property, because the assumption of a mortgage is consideration for the purpose of the Land Transfer Tax Act. So that would not be available there, but that's one thing to think about in terms of any land transfer tax planning that you want to do. There are two other exemptions available in Ontario, but they are pretty restrictive. One is with respect to family farms, and the second one is with respect to family businesses that operate active businesses. But just keep in mind that the definition of an active business for land transfer tax purposes does not include the leasing of real property, and also just may be very inconvenient, because basically they want, for land transfer tax purposes, for that property to be in the same company as the active business, versus you may want the real property to be in a separate company. So it may not be the most useful exemption out there. Now I'm going to end with just a review again of some common GST, HST traps. And we see these in the house flipper and the teardown situations. And really it's related to two concepts. One is the concept of what is a builder for the purposes of the Excise Tax Act. And one is with respect to the self-supply rules. So the definition of builder in Section 123 of the Excise Tax Act basically has, it's sort of A to E has all the inclusions, who gets included, and F has all the people that are not included. And one of the ones that we look at as an exclusion are, it excludes individuals who carry on the construction or substantial renovation, or hire someone to do the construction or substantial renovation otherwise than in the course of a business or an adventure concerning the nature of trade. So basically, you hire someone to build your house and you're going to live in it, you're not a builder under F. But if you're an individual and you hire someone to build a house that you're going to flip, if you consider that to be in the course of a business or an adventure concerning the nature of trade, then both your your contractor and yourself are both builders in that situation. So that's something to keep in mind, and that's where you end up getting a requirement to potentially collect tax. And the reason for that is, if you are a builder, then upon the sale of your residential real property, you may no longer be considered to have sold an exempt, or your sale is no longer considered an exempt supply and is now a taxable supply. So that's where you may fall into the situation where, you do the sale and you assume that, because it's a real property and it's being sold from one individual to another, that there's no HST on this. and you see situations where CRA will want to collect the HST on the full purchase price. And that's really because the effect of the builder definition takes you out of the exempt supply as found in Schedule 5 to the Excise Tax Act. Now, the self-supply rules is a related, not necessarily specifically, it applies in a situation where really the purpose of the rule is to basically ensure that builders who use their own labor don't get a GST, HST advantage over those that basically have to pay for the services of a builder to construct their property. And the self-supply rules are found in Section 191 of the Excise Tax Act. And the reason why it's relevant is it deals with some of the timing issues. And essentially under subsections 1 to 3, where a builder or constructor substantially renovates a real property and they either use it for themselves or they lease it to someone, and that's that lease over 12 months, then the builder is deemed to have received a taxable supply, and that triggers the requirement to remit the HST. And the timing of the supply is relevant. It's either the time of construction or substantial renovation is substantially completed, or the later of when that property is actually rented or occupied. So this is definitely a rule that people can fall into. Now, there isn't a personal use exemption. So if the builder is an individual and they're going to use it for themselves, and I think D is the most important thing, the individual has not claimed an input tax credit in respect of the acquisition of or improvement of the property. So if you're an individual who's a GST, HST registrant, they're not claiming input tax credits for this particular build, then they may fall into these rules and they may be exempted under 191 sub 5. But we need to keep in mind that, again, we run into the situation where you have, let's say, person builds a duplex or a triplex. They're going to occupy one unit and they're going to lease out the other unit. So they may fall into the 191 sub 1 to 3 scenarios. And then the question becomes, when do they have to self-supply? If they have to and they don't qualify under this exemption. So there's case law on this. So the term primarily means for this definition, so if at least 50% of the square footage of the property is going to be used for yourself, for your personal use, then you meet the definition under B of the property is used primarily as your place of residence. So that's where you can run into these little tricky things on the GST side, and it becomes really a timing issue again, and that's where the self-supply rules can really become an issue. So that's primarily it for my presentation. I know it's 1 o'clock, so what I'm going to do now is I'm going to go through some of the questions before. I'm going to apologize on some of the more detailed questions. I'm going to try to hit some of the quicker ones. So is there a land transfer tax on a single wing butterfly transaction where the property is transferred to NewCo as a division of the asset? There is an exemption with respect to certain butterfly transactions. It is very technical, that exemption, because it's found in the particular Ontario regulation. So again, this is only applicable to the attendees in Ontario. The answer is there is a regulation. It is technical. Basically, if you fit into that regulation, you will be exempt, and if you fall outside of it, then otherwise that exemption will not apply. Real estate developer purchased an old building for redevelopment for sale before demolishment. They applied for the permit. The old building was rented out. Is the rental income an active business income or passive income business? So just remember that rental income. So within the corp, I assume this is within the corporation. That rental income will not be active. unless you're saying that it's ancillary to the development of the property. So it's really just a question of fact as to whether that rental income is ancillary to the overall development business. So if it's for, a 2 or 3 month period of time, then perhaps that is ancillary. But if this is a longer term lease, then it may cross from being ancillary to being the primary purpose, and in which case then that rental income would fall within the specified investment business. It's really just a question of fact. So you'd have to, I think the biggest concern there would be the amount of time, but that might not be the only factor to consider. But really, that's the test to think about. So I'm just going to keep scrolling up. So there's a good question here about issue when, so let's say the parent is added to the ownership because the mortgage company, or so the child needs to qualify for the mortgage. So the parent is added on title. So what I would say there is you have a couple of things, because really the parent there, I think I don't want to be too much of a lawyer here and try to sort of massage the fact pattern, but it would seem that in that situation, it's most likely correct to say that the parent there is acting really as an agent of the kid, because I apologize. The kid is the parent there is going to probably want the kid to beneficially own this house entirely. The parent is just there really to appear on title. So what I would say is probably good practice is to have a bare trust or some sort of agreement in place to document that the parent is there. It may seem, I know it may seem like a little, again, overkill, especially in a family situation, but I would suggest that that's probably the best or the most correct factual consideration. So what I would say is in that particular case, I would definitely say that in that situation, the beneficial owner is the kids or is the child, and in which case the child is the one that's actually the taxpayer in the analysis of the principal residence exemption, and therefore should qualify for the entire housing unit. And so you shouldn't be, because the worry in that particular fact pattern is that the adult parent and the adult child may each have their own properties that they may each want to claim principal residence exemption on. And you don't want the situation where they're using it in one and not the other, or that's, the first person that uses it and designates their exemption may run into issues later on. So what I would say is, I would say that you probably do have some factual basis for you to say that it's a trust relationship, especially if the parent is there on title, but the kid is the one that child's family is the one that's bearing all the mortgage costs, all the property tax costs, all the costs of repairs, basically all of the incidents of ownership. The parents aren't living there. Those are all factors that would support this sort of trust argument. So that's what I would say. Otherwise, you may run into the situation where you run into the potential where you cannot claim. The other planning situation that I have seen that I don't necessarily recommend is registering the property as tenants in common versus joint owners. The problem with that is that it does make a distinction on the land registry that 99% is owned by the kid and 1% is owned by the parent. And then it's really that 1% of that housing unit is technically not owned by the kid, it's owned by the parent. And really, although the kid meets the test, the parent really wouldn't want to designate that 1% as their principal residence for that particular year. So that's where there might be some leakage. Now, one other question was when the child is included on title because the parent wants to claim, basically the parent is there to avoid probate tax. So I think there, again, you have the inverse situation where, again, the parent is the one that is bearing all of the gain, like they're bearing all the financial, they're the one that paid for it, etc. When you're allocating the gain to the joint owners, you're likely to allocate based off of how the money was put in the first place. So just because they're joint owners doesn't mean you have to allocate the gain 50-50. Joint owners can allocate unequally. So in that particular case, I think it is fair and good reporting for you to just report all of the gain at the parents level, because they are the ones that actually bore all the economic burden to purchase the property, and they are the ones that are going to claim the principal residence exemption. So here's one. One question. So if you filed the 45 sub 2, the question is, I filed the 45 sub 2 election. I asked CRA for confirmation. I haven't received it. Is this going to be an issue when I claim the years for the PR in the subsequent year? So I've found the same way where CRA doesn't confirm, because again, it's not a standard form. So when the person at the call center looks at the screen, they don't necessarily have a thing to look for. What I would say is, to the extent that you are documenting that you've submitted it, so to the extent that you have confirmation somehow that you've had it, that should be fine. One thing you can do is just file access to information request. And if you have a copy of your request, you could basically ask them to provide you a copy of their copy of the return they received. That might be a simple way to get it. It's $5 charge to file the access information request. Maybe if you ask for that particular year's tax return, it should be in there, because they do scan if you file a paper copy, they will scan it into the system. And obviously that return would go in on paper. So that might be the other way to get confirmation. But to the extent that you have, as long as you have some sort of basis, and I think those would be the two ways to do it, either keep a copy of what you filed or to do the ATIP request, you should be fine to take that filing position in a subsequent year when you're doing the calculation of the principal residence exemption. All right. The parent helping the kid. So just to deal with the bare trust and to deal with the third parties. So to the extent that would you need to disclose to the mortgage lender who the actual beneficial owner is. So there is this is where you run into sort of a more tricky stuff. Technically speaking, I would say that technically speaking, if you had a bare trust, you could register the land title to be, Mr. X in trust for Xco, and theoretically that would be registered on land title, and that would be, all the third parties would be fine with that. When you don't disclose it, do you run into issues with your mortgage? As a technical matter, you probably are running into an issue. As a practical matter, is this something that happens and that is common? I would say it happens. Have you met the terms and conditions of your mortgage? Probably not. I'll leave it at there. It's sort of, I can't give sort of that answer. I think what I would say is basically, the terms of your mortgage are likely want you to disclose who the actual beneficial owner is. But as a practical matter, these things happen. I've seen it before. Whether it should happen is a separate question. I'll leave it at that. Now, I know there are some other questions, and I apologize because I will say that these questions don't go in sequentially on my end. So I am going to cut this off. So if there are any questions from this webinar, feel free to email me or give me a call. I'll be around. And again, If you would like to rewatch this webinar, you will get a link either today or tomorrow to watch it on YouTube. So again, thank you everybody for attending. I will close up the session now, and we hope to see you guys back in September when we do our next webinar. So thank you.